So, hi everyone, and thanks for joining me again on the Micha.Stocks show. And today we have a special guest. He's a professor of finance at Stern School of Business at NYU. He teaches classes in corporate finance and valuation, primary for MBA students, but also grads. And most important, at least from my perspective, he shares everything on his website and also on his YouTube channel, where you can follow everything or all the thoughts that he had is in his mind. I want to welcome Aswath Damodaran, and I hope again I didn't mispronounce your name. Great having you in front of our viewers.
Thank you for having me on. I'm looking forward to this session.
Excellent. That's great. So the way I and I'm sharing it very openly, the way I stumbled upon your channel is coming from a business perspective. Looking at metrics like PE seemed for me to be a bit outdated. And then finally, I found someone that kind of talks from my mind, that evaluates companies in different ways. To spark the conversation, to start kind of engaging, what are the three, in your opinion, the three key items that everyone looking into a company needs to look and value companies according to?
Rather than call them items, I'm going to call them drivers. I mean, you might look at the past to get a sense of what those drivers are. You can look at, what other people are thinking. You can listen to management. Here are the three drivers for any business model. The first is growth. Now, how quickly are you growing? And for that, I think the place to go is look at revenue growth. Why revenue growth rather than earnings growth? Because you might be able to grow earnings even if your revenues are not growing by cutting costs or by playing accounting games. But to grow revenues, you either have to sell more stuff or charge a higher price. So that's the first driver. The second is you can get all the revenue growth in the world, but ultimately as a business, the way you're going to be able to be judged is to make money. So the second driver is margins. And when we talk about margins, we're looking at what kind of profits do you make on those revenues or expect to make. None of these drivers have to be today's numbers. They have to be, forward-looking numbers. So you got revenue growth, you got margins, and then you got to think about how much do I need to put back into the business to grow. One of the sayings I have in my class is growth is never free. So you're not an Excel spreadsheet. You can't just change growth rates from 10 to 20%. To grow faster, companies have to put money back. What am I talking about? If you're a manufacturing company and you want to grow, you got to build new factories. If you're a technology company and you want to grow, you might have to do R&D. If you're a user-based company like Uber or Airbnb and you want to grow, you might have to go acquire customers. So revenue growth, margins, and this measure of how efficiently you deliver growth basically can encapsulate any business model you see out there. Now, of course, underlying all of this is uncertainty and risk. You'd prefer that these numbers be predictable and safe, but you don't get to pick. So risk is always the guest in the room you don't want, but you got to acknowledge. Revenue growth, margins, reinvestment, and this risk measure essentially are what drive the value of every business out there.
And one of the amazing things that I really valued in your lectures and other videos that you kind of uploaded was the fact that you don't shy away from growth companies. From my experience, most, let's call them value investors, kind of to categorize and not in a bad way, shy away from growth stocks, whether it's the FANG stocks, whether it's the Tesla stocks of the world, Uber of the world, like you mentioned, Airbnb and others. And you dive in and say, even those companies can be evaluated. Does that mean that maybe PE is not that relevant as a metric?
I think the problem is, and I'll say bad things about value investors, value investors are the laziest creatures on the face of the earth. In fact, I did a session in Omaha about 6 years ago to the people who come to Omaha to go to their Woodstock for value investors, listen to Warren Buffett speak. And the title of my session is, Where's the Value in Value Investing? And what I meant by that is most value investors have never, ever valued a company. So what business do you have calling yourself value investors? You're saying, how did they pick stocks? They, when I call them lazy, here's what they do. They look for stocks with low PE ratios. They latch onto them. Why do they make money? Not because of some great insight, but because of mean reversion. It's a statistical force, right? If you buy something that's below average, if it moves to the average, you make money. And for a century, that's what drove value investing. So much as value investors like to put this mantle of being the grown-ups in the room, we're the ones who think about value, the reality is they've never valued companies. But here's the problem when you use a blunt metric like PE ratio. There's nothing wrong with PE ratios per se, but it's one in a bunch of metrics you will even have to look to get a gauge of whether a company is in fact an inexpensive company or a cheap company. But for many value investors, if you just use PE ratios, you're almost by definition never going to buy a growth company.
That's true.
Because all you're going to get are either cheap companies or companies that are on their way out. So, in fact, one of the classic problems with being an old-time value investor buying low PE stocks is if the low PE doesn't mean revert and keeps getting lower, you're in what's called a value trap. There have been a lot of value traps over the last 30 years where you bought something that looked cheap, but it kept getting cheaper. So I think the problem for value investing is they've never really valued companies. If you don't really value companies, it's very difficult to find a growth company that actually fits the need of, hey, is this company cheap?
And I think that kind of connects to your, and it's a great story from both evaluating a company, which is high growth, exiting maybe too early, maybe not, but it shows on a process, and that's the story of Tesla. So you evaluated, I think, 3 or 4 times Tesla over the last decade. You probably know better
a dozen times. I started in 2013. Most of the companies that I fall in love with in terms of looking at them as stories, I value pretty much every year. Amazon, I've valued 27 years in a row. I still tell people everything I know about valuing young companies, I learned in the process of valuing Amazon. So I valued Tesla for the first time in 2013 when it was a tiny company selling 20,000 cars a year.
Yeah.
The only people who owned it were very, very wealthy people in LA. Now, I lived on the East Coast then. I hadn't seen a single Tesla when I first valued Tesla. I valued it every year since. And I think you're talking about the fact that in 2019, when I valued Tesla, I found it undervalued.
That's true.
Undervalued in spite of the fact that it sold only at that point 300,000 cars. Undervalued in spite of the fact that it was losing tons of money. Undervalued in spite of the fact that it was run by a man who is an incredible visionary, but behaves like a teenager, has no sense of limits and constraints in what he does. I bought Tesla in spite of all of those things because as I saw it, the company had potential that could play out as a very valuable business. But to do that, I had to take the jump into the future and say, hey, I don't care what Tesla is doing right now. What can Tesla become? And I think that requires going beyond spreadsheets where you plug numbers in. That goes to telling a story about the company. So it's something that I've had to learn the hard way, that when you value growth companies, you can't sit with an Excel spreadsheet. It's not a financial modeling exercise. It's an exercise in telling a story that's grounded in what kind of business this company is in and recognizing how it will play out in the numbers in the future. So in June of 2019, I found it cheap. I bought it. But the rest of the story, as you know, is there are 2 things I worry about when I buy a stock that I think is cheap. The first is that I'm wrong and the stock keeps going down. That's a problem. The second, and this is going to sound like a strange problem, is the stock goes up, but it goes up too much too quickly. You buy a stock that's cheap, it goes up, let's say it triples over the next 2 weeks. It creates problems, and here's why.
Yeah.
And it's now gone from being undervalued to overvalued, essentially overnight. And if you're being consistent with your philosophy that you buy cheap companies, if you bought them because they were cheap, you got to get rid of them when they're expensive.
That's true.
Tesla quadrupled in price over the next 6 months. So in January 2020, I sold Tesla. And I told people, look, it's been a great stock for me, but given my philosophy of buying things that look inexpensive, look cheap, it's now not meeting the test. It's become expensive. I've sold. And I haven't heard the end of it since because the stock is up tenfold since I sold.
Yeah.
And the question I've often been asked is, are you sorry now? A lot of people who read my blog are Tesla enthusiasts. They believe I should never have sold. And they ask me whether I have any regrets. And I tell them, look, in investing, regret is one of the most dangerous emotions you can have. First, regretting something you did or did not do in the past is not going to change what happened. So what's the point of regret? The second is regret is insidious because once you start regretting what you did in the past, here's what it does. It changes the way you behave right now.
Changes your process.
Changes your process. And I said, look, given the choice between making 10 times more money on Tesla and abandoning my investment philosophy, I would rather give up the 10 times value to keep to a philosophy that I feel that I can believe in, that I have faith in. Sometimes having an investment philosophy means leaving money on the table. And you got to be okay with that, because otherwise, I mean, you might make some money by abandoning your philosophy, but then you have no core philosophy. You're going to do whatever everybody else is doing. And guess what? That's what 95% of investors out there do. They sway with the winds. They buy whatever everybody else is buying and making money on. They sell when everybody else is selling. You become one of the lemmings, as I like to say in every one of my valuation classes. Don't be a lemming. But that's tough to do, because as human beings, we're almost hardwired to go with the crowd.
Yeah. And I think that, once I hear this story again, now that we're talking about, suddenly I realize that you might be a value investor that is not shy of not staying with the company with your value investing for years and years, because kind of the basic, just like the concept of PE, the other concept is if you're a value investor, if you're a long-term investor, then it's at least 3 to 5 years. But you're here saying, and it makes a lot of sense, value companies, but don't marry them. Even if something doesn't fit the philosophy, then it's okay to exit, which it's kind of contradicting to, if you're a value investor, stay 3, 5, 10 years
forever, right? Value
regardless.
Investing has a lot of bad advice for investors. I'll give you a couple of pieces of bad advice. Just buy a good company and forget about it. In what universe is that? Is that a good idea? First, it matters. The price at which you buy the good company matters, right? In fact, I did a post on good companies and bad companies, and good investments and bad investments. I said, don't mix the two up. You can have a good company that's a bad investment and a bad company that's a good investment. And so how can that be? Because it all depends on the price. If you have a good company that's priced to be a great company, all you're setting yourself up is for disappointment, because good is not as, so you're not going to meet expectations. If you're a bad company that is being priced as an abysmal company, buying you as an abysmal company will give me upside, even if you're just a bad company. Pricing is very different, and it's got to be brought into the game. And I think that's one piece of advice I disagree with. The other piece of advice that value investors get, that's terrible advice: concentrate. Hold 5 stocks. If you have, the word they use is, if you really believe what you're doing, why would you need to spread your bets? Because I know how much I can be wrong. It's hubris to believe that you found the 5 best companies and that somehow the market is going to come around to your point of view on those 5 companies. Spread your bets. Spreading your bets is not incompatible with being a good value investor. Buying 15 to 20 undervalued companies spread across markets, geographically across sectors, is a much more sensible, less hubristic way of investing than picking 3 companies that you think are great companies and expecting them to ride off into the sunset with them. So lots of bad advice in value investing. Some of it comes from the oracle himself. I mean, I know a lot of people say whatever Warren Buffett says. I mean, it's almost biblical. He's viewed as this, Moses-like, he's got the 10 commandments in his hand and he's going to tell you what they are. He's a human being. When people,
and he has a team behind him that also drives a lot of the business. It's not only him anymore, that's for sure.
And in fact, he's had his blind spots, right? What's been his biggest weakness over the last 30 years? What's he done? What's he not done that's cost him money?
He talks so often about not investing in Amazon, for example.
Oh, no, in tech, it's not just Amazon.
In tech,
he avoided tech stocks for 30 years. And his rationale was, I don't invest in anything that I don't truly understand. You know how dangerous that advice is? I'm getting to a point in my life where I don't understand a lot of what's happening because I'm older. I don't understand the fixation with TikTok. I'll be quite honest. My kids watch it all the time. They don't watch YouTube. They say, who'll watch for 12 minutes when I can watch in 2 minutes?
That's true.
If I say, look, I don't understand people's fascination with TikTok, therefore I'm not going to invest in TikTok, think of how much I'm going to take off the table. as I get older. This is why many value investors are older. You know what they hold in their portfolios? Coca-Cola, Kraft Heinz. Why? Because they're still drinking a lot of soda. They're still eating a lot of crap. Cheese that stays melted for the rest of eternity is not really cheese. And they think the rest of the world still likes sodas and melted cheese. It's a delusion. So I think that we need to let go of some of these notions, even if they're said by people that we think are legendary investors. Even legendary investors have blind spots, and you got to be careful not to take their blind spots and make them yours.
And from the guru from Omaha, we can dive into your comment. I would love our viewers to hear the way you think about Facebook and now called Meta, but I do want to talk about exactly that, because you were very outspoken once about the evaluation that you made of Facebook or Meta being cheap right now, but also on the fact that why you shied away from investing in it because of the name change. So let's start with the name change. We talked about TikTok. Probably that is one of the reasons that Facebook is no longer Facebook, but actually Meta. So and I don't think all the viewers even thought that way of what a name change creates for a company.
As with Tesla, I have a long history with Facebook. I valued it for the first time at the time of its IPO, before its IPO. So I've tracked Facebook's ups and downs, and it's an insanely good business. Now, you can like it, you can dislike it, you might not like the side costs it creates for society. Insanely good in what sense? It's a money machine. Its margins are close to 50%. The only company I think in the S&P 500 with higher margins is Philip Morris, the tobacco company. This company makes money hand over fist. And of course, the way it does it is very simple. It does it through advertising. And the reason its advertising is so effective is it knows a great deal about its users. How does it know a great deal about its users? Because users go and spill their guts on Facebook, thinking they're talking to their friends. So its business model is built on invading your privacy. So when this Cambridge Analytica scandal happened in 2017, it struck me as immense hypocrisy, because people were complaining about how Facebook was invading their privacy, but guess where they were complaining? On Facebook. Which I thought was absurd. So in 2017, during the Cambridge Analytica scandal, when the stock price dropped by about 40%, I bought Facebook. And it did really well for me. It did really well. And in fact, I held it through October or November, whenever the name change was. And at that time, the stock was close to fairly valued. It did a name change, and I sold the day after it did its name change. I was actually on a podcast the next day, and I was asked, why did you sell? And I said, can you think of a good reason you would change your name? Let's think about it. There are benign reasons, right? In much of the world, people get, when women get married, they take on that, but even that is kind of, it still creates cost, but it was done because of inertia. But usually when you change your mind, it's because you've been in a scandal and you don't want people to recognize your name. It's because you've committed a crime and you want to go into witness protection. I can't think of too many good reasons people change their name. So I said, this is not good news. Companies spend decades building up the recognition of their name, right?
Building the
brand.
Change
your name, you're throwing away all of that work. So I said, they must be seeing something inside the company where the name is actually becoming toxic. And I said, that's not good news. So I sold the stock. And 6 months later, I revalued it about 8 weeks ago, and I valued the Fangam stocks, and the stock had kept dropping. Now, it was priced at about 75%. I still don't like the name change, but at the price at which it was trading at, I said, this is almost, it's almost a stock you really cannot not buy, because it's become so cheap, even with all of the toxic stuff going on. So I bought Facebook again 6 weeks ago. It shows you something about the nature of how I invest. I come in and out of companies, not for the reasons traders do. Traders do it for a different reason. They come in on mood, they go out on momentum, and they make money on a different way. I come in and out based on my assessments of value. So with Facebook, I think that much as they'd like to call themselves Meta, and think of how much trouble you had calling them Meta, I think Facebook still sticks. You can't change your name and expect people to forget your history. I don't know whether you remember this NBA player. I know he was a very talented player. I think his last name was Arnett. He was
Kevin Arnett.
Kevin Arnett, very talented player. But then he got into trouble with he had physical. He lost control. He, I think, punched his coach, and then he changed his name to Meta World Peace. Now you have a history of violence and attacking other people. Calling yourselves Meta World Peace doesn't make you a Buddhist.
Yeah.
Right. So I think name changes are often what companies do to distract, to get away from an old name. So it becomes part of the story, which is when you tell a story about a company, the fact that it had to change its name now becomes part of your story, affects your revenue growth, your margins, your reinvestment. So with every company, I try to visualize what that story is and why it's changing. And as the story changes, the value will change as well.
Yeah. And I don't know if your Israeli students told you that, but Meta in Hebrew, there are two ways to write or to spell the sound of ta, right? The meta. So there's one letter which they meant was meta as a shortcut for metaverse.
Right.
The other one, which is a different way of spelling the ta, which is dead.
Okay.
So on one hand, it's metaverse. On the other hand, it's Facebook is dead. That is the exact word meta in Hebrew is dead.
And if that's your story, the value is going to go to zero. So
exactly. And that when the name change was pronounced, we talked about it on the channel. We said, okay, we understand that it's metaverse, and then the stock, of course, dropped and everyone said Facebook is dead, which is Hebrew for Facebook Meta. It's exactly that. So now you have another way when
another part of my story.
Yeah, when you change your name, you should check the name in different languages, because some languages, it might, now of course the Hebrew speakers might not be the biggest population in the world, but probably there was someone in Facebook or at Facebook that would have told Mark Zuckerberg that the name is a bit problematic.
Yeah.
So so that was great about Facebook, and I love focusing on the Fangam because they're the most known stocks, and everyone knows them, and it's easy to be a storyteller for younger investors on the bigger companies than the smaller ones.
I mean, while we're on stories, you remember SodaStream, and it came out as an Israeli company, immense high growth story. Think of how quickly stories can crash and burn and get reborn somewhere else. So, not all stories in business are Disney fairy tales. There aren't, you asked me to value Bed Bath and Beyond. There is no happy, upbeat story I can tell for the company. You give me GE, it's a Walking Dead company.
Yeah.
The story I'm going to tell you is of a zombie company that's kind of finding its way towards its end. So your stories have to be realistic. You can't take a company that doesn't have a happy ending and give it a happy ending just because you like it. So that's the other thing I want to add about stories is your stories need to pass what I call the 3P test. Is it possible? Is it plausible? Is it probable? You don't want to tell fairy tales. You want to make sure that your story passes the business test, and then you're going to try to make your story real in terms of numbers. It actually keeps you disciplined. A lot of venture capitalists and founders tell big stories, but they're fairy tales. You'll sit there saying, really? In what universe would that be even happening?
It's the use of futuristic words. It will, when you start saying on something that will happen 3 to 5 years from now and no evidence that it might.
Right. And a lot of it is macro rather than micro. Be very untrusting of people who try to sell you companies based on macro stories. I'll give you an example. You've heard of Rivian, right?
Of course.
Electric truck company. Now we can argue about whether it's a good investment or a bad investment. But if you look at many of the people buying Rivian, the reason they're buying Rivian is because of a macro story. The macro story is that most of us will end up buying electric vehicles 8-10 years from now, either because regulation and laws will drive us there or because our consciences will drive us there.
That's true.
That's a pretty decent macro story, right? It's a plausible story. Maybe 60% of the 80 million cars sold 10 years from now will be electric vehicles. But that's where they stop. But here's the problem with selling me the macro story. The macro story can be right, but your micro story can crash and burn. What makes you think that Rivian is going to be one of the winners? There are not just a dozen players right now competing for that space. There are new players waiting in the wings with new technologies. So if you don't go from the macro to the micro, you know what you get? You get Cathie Wood, an ARC. Cathie Wood, I'll give you what I admire about Cathie. She tells big macro stories. Every single investment in her portfolio in ARC is driven by a macro story, right? Why do you buy Spotify? Because everybody listening to music on streaming, which makes sense, right? Why do you have Tesla? Everybody owns an electric car. Why do you have DocuSign? Because sooner or later, we're all going to sign documents online. Every single story has resonance. But then you ask, why DocuSign? There's no answer, right? What's so special about DocuSign? What's so unique about Spotify? You need to fill in that gap from the macro to the micro when you're talking about young growth companies, or you're going to be buying a lot of companies that just crash and burn, even as your macro story comes true.
Yeah, and she has convinced, whether mathematically it's true or not, that she bets on 30 for 3 to win. And then they will make the RK investment make sense for investors. But I do want to touch upon Netflix, because I think that the way you view Netflix, especially in the streaming world where everyone now wants to stream, Apple just won an Oscar on Coda and everyone. But when you look at Netflix, and it might be the whole streaming sector, you're looking at it in a different way, saying it's basically running on a treadmill or hamster in a cage.
It's a hamster wheel. Have you ever seen a hamster wheels?
Yeah.
Poor creature gets up on a wheel, and every time he wants, to keep eating, he's got to keep the wheel running. So sooner or later, they exhaust themselves and die, right? They keep going and going. There's no way to get off. Netflix is on a hamster wheel. Let me explain. Through its entire life, Netflix has sold a story to the market. And this is the problem with just letting a company sell a story. The story for Netflix is, hey, we can keep adding users.
That's true.
That's our strength. And in a sense, they've delivered on that story. You're saying, how do they keep adding 3 million users, especially when you have 200 million users already? Your base market in the US is already mature. Everybody who wants a Netflix account
has an account.
The way they're adding users is they're going to India, and they're going to Israel, and they're going to Latin America, and they're trying to get users. The problem is, to sign those users, they have to make content in the local language. So in India, they have to make content in Hindi. In Latin America, they got to make content in both Portuguese to get the Brazilian market and Spanish. And for Netflix, that creates this immense content cost. Now, normally when optimists on Netflix say, well, there'll be economies of scale. As the company gets bigger, that content cost should start to become a smaller percentage of revenues that will improve margins. That's the upbeat story. The problem is your story has to be based on facts. So if you look at the actual content cost at Netflix and you look at the number of users, it actually keeps track. In fact, it runs fast. They're actually spending money at a faster pace on content, even as they're adding users.
Yeah.
And I don't see an easy way for them to get off it, because they've trained their users to expect 25 new shows a day.
They're feeding that beast, saying
they're feeding the beast. And the question is, how do you tell that beast, you know what, guys, we're going to be more like HBO going forward. HBO is, in a sense, the other end of the streaming business model, right? They're much more conventional entertainment business, in the sense of, in entertainment, you throw stuff at the wall and you hope something sticks. It's an extraordinarily expensive way to do things. Yeah. You can't say, I'll make 100 movies and hope that 2 pay off. You're going to go bankrupt.
Yeah.
HBO's history is they produce relatively few shows, very few shows relative to Netflix, but they pay much more attention to the quality of the shows. A Game of Thrones is always going to be higher quality than a Bridgerton.
Of course.
And the HBO model is also much more interesting. It's a model where they have weekly episodes. Netflix is the other bad practice they got into, was dumping an entire season on. I love Fauda, which is the Israeli show.
Yeah.
And I'm waiting for the next season, but the day it shows up, they'll put the entire season on. You know what I'm going to do? I'm probably going to watch it over a day or two.
And that's it.
Done. It'll create a little bit of coffee, because one of the ways shows have continuing relevance is people keep talking about it. Game of Thrones, because it's stretched out over months. You were at the, getting coffee at work, you talk to somebody, did you see the episode? What do you think is going to happen next week? In contrast, if I see Fowler, I'm done in 2 days, and then it's forgotten in a week. So they got to come up with an entire season of some other thing to do. They've created a beast, a monster that they have to keep feeding. And for me, that's my biggest worry with Netflix. I think they will keep adding users. That's not the problem. But until they get the content costs under control, you can keep adding users and actually become a less valuable company, because you can't convert, you can't monetize those users and start delivering higher profits.
And it's interesting because in the streaming world, when you think of what Apple is doing, and they're just entering that arena, they kind of learn from HBO, learn from Netflix, and they're trying to combine having sometimes they drop a series, sometimes they go week by week.
I'll be quite honest, I don't really know what Apple's end game in the entertainment business is. And here's the problem with being a $3 trillion company. When you're a $3 trillion company, if you want to enter a new business that's actually going to have an impact on your value, it has got to be immense.
Yeah.
So that's why when Apple Watch came out and people got excited, I said, if you're taking a look at the numbers on this business, the entire watch business, smartwatch, stupid watch, Swiss watches, cheap watches, is about $60 billion. That's the total revenue of the business. Let's say you get all 60 billion, you get 100% market share at 60 billion revenues. Let's say you make 30% margins. That's a really high margin. That's 18 billion in operating income. But if you're a $3 trillion company, this is like a drop in the bucket.
Yeah.
When you're $3 trillion, the next big business you enter into has to be huge, and you got to make a lot of money. Entertainment is not that business. So for me, the way I see Apple is playing a very interesting game. It's trying to get people into the Apple ecosystem. There are 1.5 billion people now with some kind of Apple device that get all of their software through the App Store, that essentially have the Apple operating system running their lives. They want to keep, so to them, I think entertainment is more, it's not about making money. They don't even care.
It's the ecosystem.
It's about bringing people into the ecosystem. And that's actually true for Google and Facebook as well. I mean, think of all the Google products you and I use for which we don't pay. My blog is on Google Blogger. I'm immensely grateful for Google for giving me this free space and a platform where I can reach people. Many of your documents are Google Docs. That's Google true. Makes no money on Blogger. It doesn't make any money on. So there are all these, even Android, right? This great product that runs the non-Apple world. If you ask how much money has Google itself made on Android, it's nothing. It's actually kind of subsidized. It's all about keeping people in the Google ecosystem and then figuring out ways. So how do we make money off this ecosystem? Right now it's through advertising.
Yeah.
But I think that's something that creates it. It's interesting because we're competing against Apple. It's terrifying. It's terrifying because if your business is streaming like Netflix is, and Apple really doesn't care about entertainment as a business, it could spend 50 billion, I mean, near 200 billion in cash. It can throw money at this problem.
Yeah.
I'll be quite honest. I think the entertainment business is breaking because of what Netflix and these new streamers are doing.
Yeah.
The traditional entertainment companies have two choices. They can stay out of streaming and shrink, or they can get into streaming and crash and burn. There's no good choice.
There's no good choice.
Take Disney. What's Disney done over the last 2 years? Everything in Disney has become about Disney Plus.
Yeah.
Disney streaming, which is fine, but they're playing the Netflix game. Next year, Disney is actually going to spend more money on content than Netflix is going to. It's like 25 billion.
Which is crazy when you think about it.
Which is crazy. Because in a sense, they're milking their cash cows. You know what the cash cows are, right?
Yeah.
The cash cows are the theme parks. They're milking the movie businesses. But right now at Disney, they're the stepchildren. They're basically there to supply the cash. Everything is about Disney Plus. And that's, I know, as somebody who's loved Disney as a company and I've held Disney in the past, this is not good news if you're a Disney investor, because you're going to go down the rabbit hole with Netflix. And then you're going to ask yourself, where did my cash cows go? Because guess what? You ignore them for long enough, your theme parks. I mean, right now, if you've gone to a Disney theme park, one of the nice things about going to Disney, used to be about going to the Disney theme park, is you paid one price up front to get in, and there were no additional charges. Universal Studios, for instance,
now it's not even
paid
close.
$40 for this extra pass that got you to the front of the line. Yeah. Disney, it was one and done. Today, if you go into Disney, you have to pay an extra $25 if you want fast passes. Everything is add-on. And I can see why Disney is doing it, right? It's a cash cow. You want to milk the cow, but be careful. If you keep milking this cow and you don't keep nourishing it, it's going to die. Disney's core still lies in its theme parks, right? Much as we'd like to think, because that's where its future customers.
Yeah, that's totally true.
And by making Disney what they're doing, they're risking that core business for the future.
When they're eyeing a business that might be valuable, but right now it's very risky. I wanna wrap things up with the last question for both our young and veteran investors. If you could sum up for them, what are the things that they should learn? Because I believe that investing is a learning process that never ends, basically, but you got to start somewhere. How do they, or what are the things that they should learn to do or practice to do better in order to become a better investor, whether it's storytelling, whether it's evaluating companies? I don't know. You probably have thoughts on that, mainly for the young, but also for the veteran investor that might say, you know what, I didn't think about that. Let's start doing that as well.
The first thing is decide what game you came to play. There are two games you can play in the market. One is the investing game, where you find things that are cheap, and we'll talk about what you need to do that, and then wait till the price adjusts and you try to make money. The other is the trading game. The trading game in many ways is a much more honest and easier game to understand. The way you make money in trading is you buy at a low price, you sell at a high price. What drives prices? It could be cash flows, growth, and risk, but it's also mood and momentum and behavioral factors. So I'm not one of those people who looks down on technical analysis and charts, because if you're a trader, guess what? A chart is probably a much more honest way of assessing mood and momentum than sitting there looking at the past 10 years of earnings.
That's true.
The first choice you got to make is, did you come to invest or did you come to trade? And if you tell me you came to trade, I have complete respect for the choice you made, but then behave consistently. Everything about trading is about detecting mood and momentum. So it's the game that you play when you look at charts and you look at what other people. Remember the old Keynesian description of the stock market as a beauty contest, where your job is to not judge who the best looking person on the stage is, but to judge who everybody else in the judge panel thinks is. So you're looking at the other judges. You're never looking at the stage, because it's not about the stage anymore. So in trading, it's all about watching and detecting shifts in mood and momentum.
That's true.
When I had to make the choice, I chose to be an investor, not because I don't like trading. I think you can actually make a lot more money in a lot shorter time trading than investing, but because I'm not a good trader. So that's the second piece of advice is, if you pick a choice and it doesn't work for you, don't keep flogging that choice. You've got to be pragmatic and say, I'm not a good trader. I can't keep buying and selling Bitcoin. It might work for other people. It's not working for me. So if you come to the investing side, here's my follow-up advice. When you invest, remember a very basic rule. You don't invest to get rich. You invest to preserve and grow wealth. So if you want to make $100,000 or $10,000 into $1 million over the next year, and you ask me, what investment advice would you give me? I'm going to tell you, don't be an investor.
Yeah.
That's not a realistic, because when you set that kind of target, you're going to do stupid things and take stupid risks. You're going to put all your money in an option, because that's the way you get from 10,000 to $1 million. You invest to preserve and grow wealth.
And you buy out of the money because the delta needs to be high enough.
And that's that money. It's one of the things that frustrates young people, because the reality is when you're young, you don't have wealth. You're saying, well, you're telling, your advice for me is pointless because I don't have wealth. I have very little wealth. You know what? That's why investing should always be secondary to your life. You have a job as an engineer. Don't sit there all day thinking about portfolios and what to buy. Just do your job as an engineer, because that's how you become a better engineer. You make more income, you get wealth. And I think that's what troubles me about some of what's happening when I see younger people who call themselves investors, is their entire life is about what can I do in the market. They're not paying attention to their regular jobs as lawyers or bankers or engineers or doctors. They're so busy picking stocks. And my advice is build up wealth by doing something that you're good at and getting paid, and then think about investing as a way of preserving and growing wealth. And if you decide that you have enough wealth to do it, be humble. Don't jump in all at one time into one company, and find an investment philosophy that fits you. That's key. Because don't go look at what Warren Buffett did and Peter Lynch, which is what we tend to do, right? We go to a bookstore and go, what a great, and then we try. It doesn't work. What worked for Buffett won't work for you because you're a different human being. And that requires trial and error. You try something. I tell people the ultimate test in investing is the sleep test. And the sleep test is, if you lie awake at night wondering how your portfolio is doing or what's something in your portfolio, you fail the sleep test.
Yeah.
So if you're worrying about your portfolio, you've already failed the sleep test. Listen to your own self telling you this isn't right for you, and go back and tweak your investment philosophy till you find something that you're comfortable with. Because I think staying within what works for you, what your philosophy is critical to be a good long-term investor.
Excellent. Aswath, I want to say, like we say in Hebrew, Toda Rabba. Thank you very, very much for the time you spent with our viewers. And of course, I'd love to have this conversation every few months to see what has changed. Maybe the streaming world went to the moon and we missed it. Or maybe Tesla now is undervalued. Oh, in a few months would be, not now, of course, but in a few months would be undervalued again, and everyone would jump in after they fought the FOMO that exists right now because it's only going up. Thank you very, very much. And to all the viewers that are not aware of the amazing blog and website, I'll share the link here in the description below that you can, of course, see both the YouTube channel and the blog and the website. I follow it on a daily basis. Every time you post something, every time there's a new video. I think I went through the courses already twice. I know there are 28 sessions. I know the amount. I know all of them almost by heart without even attending or leaving my basement home office. So thank you very, very much for your time. And of course, I'm sure the viewers would really appreciate it. Thank you.
Thank you. I really appreciate it.